We have a very interesting conversation today with Nicolas Huras. We started this series of mobilizing private capital to spark social innovation with Peter Woofley talking about venture philanthropy, philanthropic impact investing. And after 4 months, we are here trying to look at the future and why we think that venture philanthropy will have a very prominent role in the post-COVID world. And as I mentioned, and you probably seen this spectrum, if you want, or this graph in very many of these webinars, because at the same time, it's not only the framework that we have been using, but it's also a little bit the agenda that we had in all these webinars. So between traditional investment, purely return-driven and financial return-driven, and traditional philanthropy that it had an impact focus, we have seen that there is this whole impact economy that I would say blooming at least in the last 5 years, but it's been here for a lot longer. And we try to represent many of the different players in these conversations every Wednesday. Now, today we are going to go to our humble beginnings and actually talk about venture philanthropy and try to go a little further of our initial introduction, where we talk about also a very specific model based on the ELEA Foundation, and Peter Woofley was very kind to share. And I hopefully later on in October, a book will come up about that we co-author with Peter. And if you're interested, you send me an email and we will send you a copy. So today we are going to focus on venture philanthropy. And you heard the definition already of what impact investing is, what an impact investor is. And we talked that it's somebody that places capital actually actively, purposefully on enterprises that generate a measurable, desired, beneficial social or environmental impact. So you have an idea of intentionality. You are looking for a specific purpose or impact, and that impact has to be measurable. And an interesting thing, and sometimes what we're going to have, and we're going to see even much more on venture philanthropy, is the idea that many times the outcomes that come from financing these ventures would not have occurred or would not have existed without this investing. And this is what we tend to call additionality. When we go with the traditional impact investing definition, we do clearly have an expectation of financial returns. And those expectations of returns can go from highly concessionary to really above market returns. When we go to this particular space of venture philanthropy, and if we want to trace it back, it really came from John Rockefeller in 1969. And I'll give you, some of you are already many times here with me. So that was actually the year I was born. So that's not new. It's a little old, I would tell you. It's almost 50 years in existence. And he actually coined this word and said that it was an adventurous approach to funding unpopular social causes. So I hope we're reaching a time where we're trying to fund more popular social causes, but it was unpopular for the financial sector. And what made them unpopular in many cases was precisely the perception of risk. So really venture philanthropy came, tried to put together to where philanthropy actually met or meets investment. And it was the application or the redirection of venture capital, if you want, to achieve philanthropic goals. So we try to marry it. If you look at the European Venture Philanthropy Association, it has a definition that says that it's the high engagement and long-term approach whereby an investor for impact supports a social purpose organization to help maximize that social impact. And I think when you hear high engagement and long-term approach, many times that yields or that amounts to high transaction costs and to costly spaces. So in many cases, you are going to see venture philanthropists working in a space, and this is very purposefully done, for example, for the Lea Foundation, working on the valley of death. The valley of death in finance is that space in a entrepreneurial endeavor where you already have a proof of concept, you are starting your commercialization period, you are trying to scale up, but it's where a lot of companies, but they're still not having a positive return, if you want, or profits. So in many of these cases, many companies is where they die because they try to scale up, they overstretch themselves. And this is why many venture philanthropists have focused on this space precisely to help the pipeline scale up. So then these social purpose organizations we can have a strong pipeline to get to commercial investments. So as you know, and we hope with Nick to have a very lively webinar today. So in the bottom of the screen, you have the Q&A. And here, Patrick Reichhardt is the research fellow at the center, as I told you, will be supporting us. So if you have questions, please write them in Q&A, not on the chat, write them on the Q&A side. And if somebody else asks a question that you really like, if you click on like, there is a like in that question will pop up at the top, and I will see it that there are 2 or 3 or 5 or 6 people interested on that. Without much further ado, and I want to thank you, Nicolas, for being here with us, let me introduce you and give you a little bit of a bio of who Nicolas Huras is. And he's really an experienced leader in asset manager that serves as a mentor and an advisor to many fintech and impact investing companies across Europe and Asia. He's currently located in Singapore, where he also chairs a digital innovation committee of Investment Management Association in Singapore, and he leads a fintech acceleration program for the industry. So he's a senior director in a leading Swiss bank and asset manager. He's responsible for APAC activities and fund distribution platform in Singapore. Before, he acted as a head of alternative fund structures and a head of EMEA business development for traditional funds. He's worked in 2002, he created actually here in Switzerland an impact advisory firm, and he focused on venture philanthropy. And he worked actually with more than 500 impact investment leaders in a network that was created and that is still in place. And he holds an MBA and a Master in International Relations. And to tell you a little bit also, the story is where I actually met 20 years ago, Nick. He was a student of mine in a previous lifetime, teaching international macroeconomics and also quantitative methods. And I think I wanted to point also this out and on how important to stay in touch and to build this network that is part of this ELEA webinars intention to convene like-minded people and actually follow in our careers and open the spaces for collaboration. And he's the person that actually introduced me to Jean-François Manzoni. So the world is extremely small in this space of working for impact. And a couple of you in the webinars that I have also met. So thank you, Nick, for joining us. He also has a broad experience on executive education and in leadership programs at top universities from Harvard, Cambridge, INSEAD, and he's an active member of many boards and boards of directors. So I hope you are going to enjoy today our conversation and profit asking a lot of questions. Now, you work at a large Swiss bank, and now you're here talking in a personal capacity, not about your current position, but really I know that you're talking about a topic that you're absolutely passionate and that you actually help build, I would say, the ecosystem around it. So how did you get involved with venture philanthropy? What can you tell me a little bit about why it matters to you? And again, thank you for joining us here.
Thanks, Vanina. It's absolute pleasure being here. I'm not sure if I'm on the screen right now because you are. But definitely it's a great pleasure being here. It's absolutely wonderful opportunity to speak with you and discuss this topic with you in the sphere of IMD, which it was so close to my heart when I was living in Geneva. Before moving to Asia, before moving to Zurich. So I was actually always passing by Lausanne and Montreux and all this area, obviously beautiful, beautiful coast of the Lac Léman. So it was absolutely a pleasure to be in touch again with Switzerland and be in touch with IMD in that form. So how did it all start actually? Everybody goes through certain experiences in life. And for me, there was sort of a shift point when I was working for a financial company, for a financial advisory company in Nyon. Actually, at that time, we're structuring funds for commercial purposes, funds in Cayman, funds in Channel Islands, funds in Switzerland and Luxembourg, and realizing that basically the bottom line was that most of these funds are really looking at commercial purpose. They're not delivering that much of different extensive returns, or they're not really delivering that much of additional value to anybody, but just pure financial, and that not always, very often the returns were actually mitigated. So when in 2011 I attended Harvard, actually it opened my mind a little bit to see the world from a different perspective. And come 2012, I started a Swiss Venture Philanthropy Forum, sort of association, initially virtual, that unites and brings together variety of stakeholders within the venture philanthropy sphere. At that time, venture philanthropy was the more dominating track, versus what right now many people think that impact investing is a more dominating track, because it's actually shifting left and right. So we don't really know which way it's going to dominate in the future. But from my perspective, I wanted to focus on venture philanthropy. And why? Because venture philanthropy was a topic that really started in 1969, as you mentioned, by the Rockefeller Foundation, but also additionally was brought back to mind twice in the coming history. In 1997, in the Harvard Business Review, there was a very famous article, what foundations can learn from venture capitalists. And I will actually paste you this article into the chat as we speak. So basically, that article opened my mind and started thinking post-crisis, what was gonna happen. And then 1998 came the big crisis. So actually everybody started thinking about different added values. 2008, 2018, we always have this 8 that's repeated for some reason. So now even 1918 with the first pandemic, right, 20th century. So basically, after the shifts, everybody starts realizing that pure financial returns and pure financial focus is not sufficient. So people basically start looking at alternatives. And this is how I looked at alternatives and thinking, but basically 2012, by starting this organization, I realized how much momentum there was. I pretty much got in touch with most of the big foundations. I got in touch with various consultants from different big 4 companies that were interested in actually participating in building this venture, building these initiatives. At that time, it was still very little motion within Geneva, but for me, it was very logical, being in Geneva, that I joined the United Nations and the foundation and the IOs and the NGOs that are actually present in the area, with all the banking, the private banking world. That's why venture philanthropy rather than impact investing, because the money we were closer to the foundations and closer to the family offices and private banks rather than pure asset management and investors.
Great. And I think
that's how it pretty much got there.
I think we have a very privileged environment here in Switzerland, as you mentioned, here in Le Mans and also in Zurich, with the different stakeholders, and that's why you got also involved. But why do you think that venture philanthropy, and we have seen the shift and the transformation in the sector and how rapidly it's changing, but why do you think is going to be the right path for the post-COVID world? What are the key characteristics or the risks that you think that make venture philanthropy suitable to answer the global challenges we have?
It's a very good question. Obviously leads us to the next point. If you don't mind showing the slide, I would actually like to highlight some elements on the slide. Basically, when you look at the main long-term risk as defined by World Economic Forum, in 2020 risk report, you realized certain momentum. You realized that mostly the societal and the environmental issues are the biggest risk, and they also have the highest impact and likelihood to actually occur. So as much as we're looking at building and bringing value to the world, we don't realize how much risk we are surrounded by. And now when we compare impact investing with venture philanthropy, we see that impact investing is focusing on different aspects of investments rather than focusing on the main pressing issues that can only be covered from a venture philanthropy perspective when we're talking about different sources of money. So basically, this is why I wanted to show you and to highlight the fact, if you're looking at the long-term risk outlook on the slide, on the top slide, which comes from multi-stakeholders on impact, pretty much half of them are green. When you're looking at the likelihood, half of them also are green, and all the other risks are actually sort of mitigated in the long run from other perspective. But here, venture philanthropy really brings the opportunity and the growth potential for the future. So we see that the biggest impact, the biggest risk, the biggest issues are the ones that will be solved by venture philanthropy rather than impact investment. Therefore, I perceive that venture philanthropy has better future in the long run than impact investing, even though impact investing started growing much faster. And I think we answered actually what venture philanthropy impact investing really is from this point of view. But when we're looking at this slide that you see in front of you, for me, it's in layman terms, it's really simple diversity or different viewpoint on the same problem. So as Vanina showed at the very beginning, impact investing comes from the investment side, from asset management side. Venture philanthropy comes by collaboration between philanthropic investors and donation-focused investors and venture capitalists. So basically, when venture capitalists realize that that there's many opportunities in the social sphere, then the philanthropists got interested, and the philanthropists realized that the impact post all the crisis that people went through, realize also that there's less and less money being actually made in venture capital. They also realize that there is more impact in venture, that the conversion of the two can create a bigger momentum and bigger impact. And one thing to mention here, what I like to mention, this sort of little anecdote, when you're working with ultra high net worth individuals, and those people basically are middle-aged, these days a little bit older. They created their businesses in the 90s, in the 80s. There's two elements that are really important. First element is means that the high net worth individuals, or the rich individual, philanthropic individuals, are basically looking to bring something back to the community because they already achieved what they wanted to achieve. And what really empowers them and makes them tick really is the possibility to speak to other philanthropists and other investors and create a community, discuss with their friends in the community when they're sitting in the chalet in Darbier. They basically having a fondue, and what they're talking about obviously is their investments, what they managed to achieve over this past year. So obviously this venture capital talk, when everybody was saying, "Oh, I invested in this company, invested in that startup," it kind of lost momentum and kind of lost interest. Also on the other side, some were saying, "Well, I'm going into philanthropy. So what did you do?" "Well, I invested $1 million in a school in Africa." So what they say, "So what's happening with the school now?" "Well, that was 3 years ago. Now the school has no more money. It's not sustainably managed, and therefore the only thing that's remaining is a plaque or on the wall with my name on it." So so you realize that there's basically lack of conversation and lack of sustainability. And when these two people and the two worlds merged and come together, they realize, well, let's work together. Let's create something that will be sustainable, that will be run in a sustainable manner, but also bring to the society and also create the possibility for the ultra high money, even with smaller returns, but to be able to be returned to the investors. So you don't just give the money and forget about it, but you actually get it back.
I know you're trying to provoke our audience. I know you're a little a little bit on this side and it is true that we've seen the traditional financial philanthropy was being questioned about the actual returns and the outcomes and the measurement of the achieved impact and the sustainability, that if they actually exit or left, what happened with those donations. And there is a transition, as you're saying, moving into this way. So what are you seeing also as the main characteristics of venture philanthropy that you want to share with us that make it interesting in this space that I mentioned before, for long-term sustained impact that can be measured? To really achieve this systemic, you presented the systemic risks, but what can venture philanthropy bring to the table to actually to have a less partial or less marginal, if you want, answer to these challenges?
Good question. And before we even move to that slide, it's very important to understand that this venture philanthropy is very close to venture capital. So it is run in a similar manner. It's run in sustainable, and it's run from a commercial mindset in a social environment. So when it's run in a commercial mindset, that means that the bottom lines and the KPIs are really there to drive the business forward. So the key characteristics are very similar to VC when it comes to a high engagement. So the investor or basically the investor or the venture capitalist is creating a hands-on relationship with the company. So they go to the field, they meet up with those business owners, they engage consultants, they basically sit down and build the strategy, and they also sit down and build the business plan. And then afterwards, they join boards and they sit on the boards and basically hold hands all the way through the entire process. Important is the performance measurement. Now, let me jump to the right side of the slide, basically. So there's the performance measurement, and performance we're going to get a little bit later into. But performance is really important, that the KPI, the planning, the outcomes, the financial accountability and transparency are really there to drive this business forward. The philanthropists are basically open the door for the business owners to a variety of networks of other investors, other business owners, potential sustainability in the long run, potential clients, potential partners in the country, potential global contacts that they have. So the involvement of networks with complementary skill sets is absolutely crucial there. Then I also mentioned, so basically, let me mention that the non-financial support, basically. So this is the providing the non-financial value-added services, where it comes from those philanthropies with a lot of experience that they bring with them. They very often are ex-business owners. They run businesses. They created multinational corporation, or they run multinational corporations. They can bring so much added value that these companies, the small startup companies, would never dream of. And this way, they have much higher chance of success. And that goes over multi-year setup. So normally what it used to be that the short-term investment was between 1 and 3 years. With venture philanthropy, we're talking about engagement is 5 to 10 years even, because we're not focusing that much of a quick buck making returns back, but we really focus on the impact per se. So when we focus on the impact, and then we know that these people are the venture capitalists or venture philanthropists are involved in the long run with all the experience. Even if they're not involved themselves, they're going to place someone, a local director, local manager, who's going to help run the company. And important is also that the financing now has diverged ways of actually raising capital, because it used to be only grants. It used to be that it started with grants, and afterwards we extended it to debt, to equity, to tailored need. So there's a lot of opportunities now for venture capital or venture philanthropists to raise financing. And the last one that I mentioned was the organizational capacity building. which is the building of the portfolio organization by funding core operation costs. So this is just the basic, just to sum up of that. But this is pretty much the main characteristic. That's how it differs from usual impact investing structures.
So it's interesting because you show here the high touch and the relationship that is built between the venture philanthropist or the team that works with the venture philanthropist and the social entrepreneur or the venture, And Ravi is asking here, is this seen as a perpetuity investment? Is it that long term, or is there an exit in mind? And what do exits look like for venture philanthropists?
It's very good question, and thank you, Ravi, for asking that. Bottom line, what I actually mentioned before was that the engagement is 5 to 10 years. So it's usually the same sort of level of engagement as long-term investment in venture capital structures, or a closed-ended fund structure, which is also investing in a variety of companies. Exit strategies I will get to in the financing and evaluation model a little bit later, but exit strategies can be various, from merger and acquisition, basically the same as the commercial company structure. Unwinding more normally merger and acquisitions could be an IPO, could be a tokenization of the company afterwards to give access to smaller investors to divert basically from large one investor diverge to a smaller group to group with smaller investments. So there can be multiple choices of different exit strategies. But I think we'll get to that a little bit during the IMM slide.
And I think we have seen, because there was very little exits in the past, but now we are starting to see more and more scale-up social ventures, especially when you're going to talk now about financial inclusion, agricultural, solar sector, where these exits are becoming. It's a complex topic, but it is actually starting to happen in the sector and becoming quite well noticed. So is there, because we are talking about venture philanthropy as if it was kind of a one size fits all. Is it the same when we talk about sometimes venture philanthropy in Asia or in Latin America and emerging economies in Europe? In your experiences, are there different models that we need to understand or different lenses to approach venture philanthropy?
Absolutely. So they definitely is no one size fits all. Philanthropy, and really not just venture philanthropy, generally philanthropy differs from regions, countries, cultures, but predominantly cultures, because different countries have different approach. And Asia also differs. Asia is a huge continent, right? So it also differs quite extensively and a lot. So I have brought up actually a few examples that are based on European structure, but I'll show you what it actually how it corresponds to Asia. So generally, as is defined by Leonora and Lisa in their study, was basically that there is a liberal model, there's the welfare partnership model, there's the social democrat model, and there's the development model. I know it sounds a little bit theoretical here, so we'll get to practical example a little bit later. We still have half an hour, so we're good in time here. So basically, those models differ depending on the nature and the country. You can imagine that the liberal model, which is a sector focused on providing services, education, health, social welfare, so mostly funding from government contract. This is something that you can see in very developed Western societies like the UK, for example, or the US, or something that is that has a big structure behind it. And then we have the welfare model, which is providing service dominated and specialized by government, and spends great amount of money on social welfare programs. So social welfare programs in Europe are perceived in Belgium, in Germany, in France, in Spain. This is where that pretty much comes into the picture. Then we have the two that are a little bit smaller. There's the social democrat model and the developmental model. So social democrat model, you can imagine in Europe, great example, obviously Denmark, Finland, Sweden. This is the social democrat model, when the funding sector derives from state-sponsored or delivered social welfare programs, where the taxes are, as you know, are quite elevated, and therefore there's enough basically capital to run the economy from that perspective. And the developmental model is really where governments are not involved, and basically everybody is relying on other sources of income or sources of wealth. So therefore, we have main focus in Europe on the CE countries, obviously the Central Eastern European countries, the ex-Eastern European countries, but also most of Asia and Latin America, actually. So this is the sources. This is where the growth actually is the highest, and this is where we have the most expectation to grow in the future, because governments, for now, historically used to have quite a bit of capital, quite a bit of money, but these days the government's more relying on individual funding, as we see with SpaceX. United States decided to outsource even the NASA space program. So therefore, we have to see and open up a little bit to the private funding with the developmental model. And me being here in Singapore, on the other hand, is yet a different model, even though it's in Asia, but it's a very modern and developed economy based on the UK system. Therefore, we are experiencing here a liberal model with most focus on welfare education and the focus of funding by the government.
We have a couple of questions on the return on investment. And I know you can have venture philanthropy, you can have concessionary money that actually does not expect the returns and goes a lot on the grant side, and you can have more commercial money. But they're actually asking who bears the cost of all this capacity building and high touching of the impact creation, and how do you evaluate the impact? I know you will talk a little bit later, but what are the expected returns? And this is Qping asking for if you think for the more private investor side of the story.
No, it's a good question, actually, and it's a question that has no one answer. Because it also differs and changes through times. As a crisis occur in the world, there's more involvement. There's also run to safe haven currencies, safe haven investment. The returns generally on venture philanthropy are relatively minor. They're not very high. I mean, we used to be experienced around 2 to 4%. Now I know that some exits actually these days, last few years, were reaching all the way to 8%, which was on an annualized basis, right? So it's not bad, I have to say. And if you consider that you would normally, as a philanthropist, give the money and actually just get the tax deduction, that's a big change. You're getting the money back, first of all. So even if there's zero return, you still can have an exit strategy where you get your capital back. I think even with zero return after 5 years, you're still much better off than investing or putting money into philanthropy money. And I will get later into the toolbox.
And there is another person actually about the taxation structures in Europe and Asia, as not-for-profit money is used to generate profits or return. No, even if it is for impact, is there a problem on that? And I know many foundations worry about that, and there are different legal structures even inside Switzerland. No, but does the tax structure affect venture philanthropy, if you want?
Well, generally, if it affects it actually in favor, because from my perspective, most of the social ventures, so the social venture organizations are structured as foundations, and as foundations, they normally have the possibility to run tax deductible programs. So I don't want to go into tax because I'm not a tax advisor, and as you know, I'm doing it in personal capacity, and definitely not doing any advice to anybody on investment or taxation. But that would be my general perspective, that it's actually in plus.
Yeah, and if anybody is interested in going into detail into the legal side, I can recommend you some people that work especially with foundations, because it is actually a complex issue, and even here in Switzerland we have different stories. But one of the features that I really like about when we talk about this conversation and setting up the topic is that you specialize actually on fintech, and we have seen that one of the key issues, at least in the last 10 years, of a lot of these social enterprises scaling up is precisely the role of technology. So can you tell me a little bit why you got highly involved in this fintech sector for impact, and what are the key learnings that we can bring from there, and why venture philanthropies are so important in this sector?
Actually, in fintech side, there's few elements from the fintech perspective. What I wanted to focus is really on a niche structure. So I was initially, I'm also involved on the other hand in a lot of fintech startup involvements, and I was always thinking, it's run as structures, and they bring a lot of value. And some of these fintechs bring a lot of value from a government perspective, or also from individual investment perspective, and they can have a social impact on the society. So why not try to merge the two, and basically find a way to get fintech under the venture philanthropy umbrella. And just from an impact perspective, when you're looking now at the slide, venture philanthropy in technology or in fintech focuses on several applications of technology that make a huge impact to the society. So if you start with the mobile money and the e-wallets, obviously you can start alternative credit scoring, which I will get to as an example a little bit later. And also cross-border remittances, especially in Africa, where you can use a mobile phone and transfer the money between the two areas, digital KYC process. But above all, even when you're talking about underdeveloped countries or underdeveloped regions in the world, biometric ID. I mean, a lot of people are still illiterate in the world, so there's still no possibility for them to read contracts and open a bank account by reading a contract and signing a contract. So being explained in a video what it actually does on the phone, and afterwards confirming your bank account opening or bank account transfer with biometric ID solves that issue. And as you know, the growth of mobile technology has been exceptional. And now with 5G actually coming into the picture, which is still very discussed everywhere in the world, who takes control over 5G, that's a different topic. It's basically the technology is going to enable IoT, so Internet of Things, and it's going to create a lot of information to be transferred around the world. So, I mean, fintech is definitely something that will bring a lot of impact in the future. And fintech has been, what I like about fintech also is the fact that it's technology that is needed. It's answering to the problems of today's world in a financial industry. And there's enough capital and enough interest to get enough capitalization in that. And that's what brings us to the financial inclusion. And as the official definition really is, it refers to efforts to make financial products and services accessible to all individuals and businesses, regardless of their personal net worth or company size. So financial inclusion is getting everybody bankable, basically. So as World Bank actually created this study where they say who is unbanked and what's the level of banking or unbanking around the world. You can see certain statistics on this slide, which are actually quite interesting. Who is more likely and less likely to be still unbanked in the world? Obviously, gender bias is a big issue, right? Still, men are mostly the providers for the family. Therefore, they will have access to the financial returns and the financial products. Now, education, obviously, in underdeveloped countries, anybody who has a tertiary education will have more chances of having a bank account than someone who only have a primary or less. And level of incomes are also important. And the interesting part is there is a huge potential for fintech and financial technology to actually address the young and the actually Generation Z, even not even millennials anymore, because millennials are fully banked, but the Generation Z in developed countries were people between 15 and 24 are still 33% less likely to have a bank account. And the last and not least on this slide is this nice orange orangey, reddish global chart in the world. And I want to emphasize on three numbers here. So three numbers. So we start with OECD countries. So that's focused on red. That's the United States, Canada, and all Western Europe. There is 92% everybody being banked. So there's full access pretty much to the financial technology, and the financial inclusion is fully there. Now, but compare even Eastern Europe, including Russia and all the states, ex-Soviet Union states, basically, they're only 50% covered. And now when we come to Southeast Asia, look at Indonesia, 20%. One person in five has access to any financial services or banking services that are there. There's a huge potential. And I have an example, actually, which I will ask kindly Vanina to skip to the case study of Julo. Case study of Julo is something that actually caught my eye. It is addressing the biggest issue of financial inclusion because it is addressing Indonesia, right? So it is addressing a country that is predominantly Muslim, but at the same time has 270 million people. It's a huge country in Southeast Asia with a lot of need, requirement, and growth opportunity. The neobanks are absolutely services like Gojek, if you know, this is the equivalent of Uber in Europe, and Grab, basically. These are the transportation companies. They started diversifying into financial world, realizing that they have first of all, opening account with them is very easy. Second of all, they have the mass of people that have been using them, and they have access to not only the people using the service, but also the drivers themselves, and providing them with a variety of services. So Julo basically established this online banking tool, which allows for to test credit worthiness, and then automatically also opens online bank account for Indonesia. It not only is an interesting technology in itself because it has been now exporting to other countries, but also tests the creditworthiness and uses all the technologies in terms of face recognition to open and to manage the transaction. And they have been included in the top fintech 50 that bring impact by the United Nations. So I mean that's definitely worth it. And the impact, what I wanted to say, very interesting aspect, since they are so prominent these days in Indonesia. They actually helped through the COVID crisis quite a lot, because they provided credits to people with small microcredits, even to make sure that the society can sustain itself. So that's how Julo really caught my eye.
Yeah, and I think it's really interesting because we are seeing how disruptive these financial innovations can come and may not come from the traditional financial sector, and how the sector is shaping up differently. Are there any other sectors other than financial inclusion or examples that you want to point out and share with us that you feel that are interesting and leading the way, that have been funded by venture philanthropists, if you want?
Yeah, absolutely. And I know you have two for me. And I'm happy to show them. I'm happy to show them immediately, since it shows the logo.
And let's,
I actually chose two cases. A case that I was involved already many years ago as a Rags to Riches. Is an interesting case in the Philippines, and note that I'm actually focusing on cases in Asia. I'm aware of the fact that most of you come from Western or European countries, but on purpose, I'm trying to show you things that are happening in Asia, because I'm based now in Asia, rather than for you dealing with issues that you normally used to in Africa, Latin America. So Asia is also a region that I would like to emphasize a little bit the venture philanthropy on. So Rags for Riches is very simple, pretty much structured. It was supported by LGT Venture Philanthropy for many, many, many years, with very small amount of money that they started. And afterwards involved in their ICATS program, which basically sent them mentors, sent them consultants, and helped them really develop and engage and grow the business. But what is the business actually? there are many poor and indigenous communities that are dominated by women who have difficulty earning sustainable livelihoods, right? And basically, what the company did is to use and convert waste to usable clothes and usable materials, so that the solution for them was providing marginalized women with the product development, sales, marketing, logistics support. They trained them in organizing poor community, providing members with modules of self-esteem, confidence, value formulation, savings, etc., financial management, as well as various companies to upcycle their scrap materials and reduce waste accumulation. So they were actually they're very happy. It grew the company. I was actually checking on the website just before this webinar, and the company is really dominating the market and is really very well perceived. And what I wanted to say here, you see the application of venture philanthropy from a perspective of societal impact, right? And this is something that goes back to the risk levels that I was mentioning at the beginning. One of these boxes, the biggest issue is environmental and societal. So this is societal impact of this one. And the second case study, which I chose, was the hill tribe communities in northern Thailand. And Hill Tribe Organics is a very interesting company that provides the environmental impact as well as a fair share of business, etc. Northern Thailand has over 1 million people living almost on the line of a poverty line, because the poverty line, as far as I know, is now defined around $2.53 per day. These people living at $5 a day. So they a little bit, but comparing to the Thai average, where the average is at $25, $30, this is still very, very little, 1/5 of what the potential could be. Very often, they also don't hold Thai citizenship. Therefore, there is no access to public service, to healthcare, to formal education. They're vulnerable to land ownership disputes, trafficking, anything possible. So we're talking about a huge problematic issue. And the solution is that HTO basically contracts Thai tribe farmers to set up run free-range organic chicken farms for egg production. Well, interesting, you would think like, why egg production, right? But eggs is so common and so easy, and everybody can pretty much produce eggs. But what it created a sustainable income for them, and it tripled their livelihoods. They also provide the farmers with all the free ingredients, so organic chicken, organic feed, training, etc. And then 1% of that revenue goes into the village development fund, which then again provides infrastructure, health, education, and services in the village. So it's absolutely amazing model actually to follow, and that's all thanks to venture philanthropy that things like this were actually possible. So you see, they're not per se impact investing closer to investing in a social venture, but it's actually creating more focus on the impact rather than the return. So
you're painting an extremely rosy picture of venture philanthropy, and we've seen enormous growth and positive impact, as you're saying, but are there also some challenges? What do you think is hindering, or what are the challenges that venture philanthropists are facing these days? In your experience,
being mindful, there's obviously plenty of hurdles and plenty of challenges that we are facing, but being mindful of time, I will focus on two, which are for me the key hurdles. The key hurdles, the first one is the lack of standardized impact measurement. It is absolutely super crucial to find and agree on one level of measurement of success and measurement of impact. And this is something that has not been actually done properly, and everybody is focusing on a different model. I'll show you one model which I think is actually the best, but nonetheless, it's lacking a standardization. And the second point is obviously undercapitalization, because as I said, venture philanthropy has lost a little bit its flair for a while, but I'm strong believing that it is going to come back again especially after COVID. because COVID has catalyzed the investment and force people again to think outside and also think of environmental issues, which I mentioned at the beginning, are the crucial issues to solve in this world in order for us to move forward. And undercapitalization, what I wanted to mention is that majority of the organizations, of the investment venture philanthropy organizations, allocated on less than 2.5 million to venture philanthropy. Only a small percentage of 8% had budget greater than 20 million. And then the corporations are investing 10, 15, whatever percent. But the most important thing is what we're talking about, the venture philanthropies or the philanthropists, ultra high net worth investors. So they only provide less than just 1% of the total funding. So on one hand, it's little. On the other hand, I see it as a huge potential.
We had a question on that side from Ravi, and he's asking, do you feel that venture philanthropy works better where resources are pulled together? And you mentioned about different actors, and we have some webinars on blended finance or playing a catalytic role. And I know you have that as part of the future, but since we are having little time, and I want to include some of the questions, what do you think about pulling together different players of the?
Absolutely, this is done on an everyday basis. You basically cannot rely on one source of capital anymore. And blended finance is the future. And using the ways of technology to bring financing together, and also the ease and access to capital these days has been made much prevalent and much lighter to obtain. And it definitely needs blended finance to move forward. But I would like to move to the, if you don't mind, I know you have a question for me, but I would like to move to valuation, because I know we have 7 minutes, but it's just, and then the future, I'll wrap it up quite swiftly. But there was a question of valuation, and I wanted to mention that valuation is absolutely crucial. And the one model that I really like, and I don't know if the slides will be circulated, but basically there is a link to the video which you see on the left bottom corner. You can actually see how the valuation is run in detail. But there's a model that is called impact multiple of money, and was developed by Rice and Britspan, and it's a forward-looking methodology to estimate a pre-money basis financial value of the ESG. And then there are several elements. There are basically 5 elements of the valuation. So you check the relevance of the assessment. So the investors consider relevance and the scale of valuation. Then just identify the targets for the ESG. So identify the outcomes of ESG outcomes for the existing research. And then estimating the economic value, the EV, the social impact. Need to find the anchor study that robustly translates into economic terms. So like, what is the gist of the venture? Then you have to adjust it for risk. And what is important, what you asked, I think Ravi was asked about the exit strategy, is the terminal value, basically. What is your exit strategy? What is your terminal value? What can we expect to achieve within 5 years?
Good. So we've been trying to monetize value and to actually do these kinds of valuation, even in the VC world. So many times it's very difficult. But I think there are, as you're saying, very interesting things happening in the field. But since we have very little time now, time flies when you're having fun. What do you see as the shift of the transformation from the traditional philanthropy to venture philanthropy, even to more catalytic type of capital? What do you see are the key shifts in the future? And you brought a very nice quote that I will share with people, but if you can start telling us about some of the transformations or the things that you see for the future of venture philanthropy.
I think Chris was actually very right there to say that what they were pretty much doing wasn't really just working the way that it should be. So they had to change. And the shift, the future shift in venture philanthropy is pretty obvious and pretty visible. It started with basically I mentioned, I think 7 of them of the elements. And basically, I mentioned the strategic framing as first. So basically, looking from a widespread giving all the way to very targeted investing. What you're focusing and very targeted. Scale of intervention. Now it used to be project-based. Now it's focused on a sector. It's very sectoral based. Now a sector focus, when I say it used to be one sector, but now it's sector agnostic. So it doesn't have to be this sector, it can be variety, it can be environmental, can be agriculture, can be anything. And then we have the funding mechanism, what I mentioned already before, from grants to blended finance. And I know you wanted to say a short sentence on that.
No, you can keep going. No, I'm thinking that we are seeing more and more foundations now having this catalytic role in blended finance, and maybe even taking the first loss in order to bring other private capital. So I'm in the space that I'm working, I'm seeing more and more initiatives and pilots of trying to bring these actors together. Yeah, so I can verify that these different funding mechanisms, or the funding mechanisms, are changing a lot. Yeah.
Then we have the engagement style and period, which I mentioned before, from short period 1 to 2 years to 5 to 10 years. The culture and capacity of staff, so from altruistic administrators, basically somebody who was just doing admin work and providing this data as investment, to actually multidisciplinary and commercial people being involved in that business. And success criteria, which was I mentioned before, was the IMM. So basically defining the success criteria and shifting from pure input-output to an impact strong focus. Mm-hmm. And if we still have a little bit of time on those 30 seconds on the last
2
slide.
minutes, yeah.
But before we move on to maybe some questions that are still outstanding, I just wanted to show that there's new application models really in venture philanthropy. So traditional foundations were adding venture philanthropy as another tool to their toolkit. The corporate social responsibility becomes embedded in business culture. Government relations, very important. Venture philanthropy is catalyzing collaboration between government, philanthropic, and social sectors. And this is something that brings us back to the slide that was on the different governmental models. Governments get involved in it, pick it up. So the government money is actually entering the space of venture philanthropy. Then there is a number of social enterprises present a growing opportunity for venture philanthropy once again. And an interesting thing is the fact that venture philanthropy at some point joins and merges and overlaps with impact investing. So very often venture philanthropy is the starter point to a long journey of impact investing in the ventures in the future and bringing social value. So impact investing is used in the financial model to start up a venture, to start the initial capitalization, and afterwards venture philanthropy exits and impact investors come in and take it further. So
time is almost up, so it's 59. So thank you very much, and I really think that something I would like to you're showing how the philanthropic sector has been changing and transforming, how venture philanthropists bring to the table a key component in this social finance spectrum that we were talking about. And I think what we're trying to do with these LEA webinars is to bring different players, to bring NGOs, to bring governmental organizations, to bring corporations. Actually, in our next webinar is going to be with a person from Nespresso that actually work on a providing climate change insurance to farmers. Or so how all these different players also had to change the mindset from only impact driven to become kind of bilingual, if you want. So corporations have to understand how to collaborate with venture philanthropists, with NGOs, with social entrepreneurs, etc. And a little bit the idea of these webinars of the LEA Center for Social Innovation is to convene these players that want to mobilize private capital at scale to actually all these solutions and pretty cool solutions you brought up to the table become more mainstream and address the challenges and the risks that you mentioned. So thank you, Nick, very much.
Thank you for the opportunity once again.
And so thank you everybody for joining us, and if you want or if you have any additional questions, you can always contact me on LinkedIn or any social media, and I think also Nick is in many different venues to get in touch. So thanks so much, and I see you, I hope, in 2 weeks. Good. Thank you.